What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and what a start to the month of April, first trading day in the month of April in the United States, and we are seeing stocks at record highs. The S&P 500 closed at a record high today. The Dow Jones also closed at a record high today. Now, the mainstream story on why the stock market is rising is due to optimism about economic recovery, right? And so next week, when the stock market is down, it will be blamed on pessimism about the lack of economic recovery. These guys are just brilliant. Now, admittedly, we did get some good data. We got a big jump in services industry activity, and then we also got a boost about 916,000 jobs in the non-farm payroll report for March. Now, the cynic in me says, let's wait and see, because that's what the numbers are right now. We'll see what they end up being once they're revised and adjusted down the road. For years now, we've seen these blowout reports, better jobs, better jobs, better jobs, and then when they're revised later on, turns out they were much lower than they were originally reported. Despite all this, you guys know that I've been talking about how bad the economy really is despite the flood of money, but that flood of money is going to continue to push asset prices up, and that's what we're seeing unfold right now. Real estate, the stock market, cryptocurrency, all these assets are just getting lifted by this flood of money hitting the markets. However, there is a better way to measure the stock market, and that is to price it in something that is a more stable form of money that has been around for thousands of years. Yes, I'm talking about gold, and so today we're going to look at what the stock market looks like relative to gold if gold was used as money, and how that provides a more reliable indicator of when to shift your positions versus just looking at the price in dollars. Ready? Let's dive in. When pricing the S&P 500, or really anything for that matter, you have to choose what you are going to price it in. Now, obviously, the standard way that things are priced are going to be in your local currency, right? So for the United States, we're going to be looking at things priced in dollars. But just as you can change the measure of something from, let's say inches to centimeters, you can also change the measurement of price by changing the unit of account. For instance, going from dollars to euros or yen or Bitcoin or gold. No matter how you price something, you are assuming that the unit you are using to price it is the baseline. Now, all assets and commodities and forms of money they fluctuate in price and value. Some things are more stable long-term and have less long-term volatility or less long-term appreciation or depreciation than others. I don't know why I couldn't say depreciation there. For instance, the dollar has lost about 90% of its purchasing power since we left the gold standard in 1971. And most other fiat currencies have faced the same fate. And so when you're looking at something priced in dollars, what you're going to see over time is a natural growth in the price because it simply just takes more of those units of account in order to add up to the value of whatever it is you're measuring. If the size of an inch was constantly shrinking, you would appear to be growing taller and taller over time. But of course, we know that wouldn't be real growth. It simply would be taking more inches or more feet in order to measure you. Now, since the purchasing power of gold has stayed relatively stable for thousands of years, many people like to look at the stock market priced in ounces or grams of gold. That way they can get over a long period of time, not short amounts of time because there can be extreme volatility, but over a long period of time, you can get a little better idea of how much real growth there is in something versus just, fake growth that's really just inflation. Fantastic resource for this is a website called pricedingold.com. If you've never heard of it, I encourage you to just go check it out because it's actually a really fun website to click around and view all sorts of crazy things priced in gold over a long period of time, like Big Macs and coffee. So what we're looking at right now is going to be the S&P 500 priced in gold. Now, this website has many charts of different time frames, so you can kind of zoom in or zoom out. This one that we're looking at today is since 1870. And so this is a very, very long time frame, obviously, but it's looking at the S&P composite in grams of gold. And you can see here that there's a nice little growth channel here, which makes sense, right? Because stocks are businesses. And businesses grow. And so you'd expect that even when measured in a stable form of money, you would expect to see some growth long term. You're not going to see the outrageous, 8 or 9% long term that you would see if you're measuring in dollars, because when adjusted for inflation, it is far less than that. You need more dollars in order to buy the S&P 500 index. But when measured with a stable form of money like gold, you'd expect to see growth like this long term, where it just slowly accumulates and slowly grows and heads up and to the right. Now, obviously, we see some extreme volatility in this chart as well, and that is my point here with wanting to look at this video, that yes, the S&P 500 and the Dow are priced at all-time highs right now when you look at them priced in dollars. They're not at all-time highs when priced in gold, though. The market was more overvalued in the 60s than it is today when priced in real money. The market was more overvalued in 2000 when priced in real money, and we just recently passed the point at the the peak of the right before the Great Depression happened during that bubble. What you'll notice here is that this approach and this view of the value or the price of a stock market index, it gives you a lot more clarity on when to buy and sell gold versus stocks. Because if you notice, let's just work backwards in time here. Right around 2011, that would have been according to this chart, that would have been a good time to start selling your gold and buying stocks. Start shifting some of your gold holdings into stocks. Because according to the long-term trend here, that's about the lowest it was going to, the lowest that stocks are going to get in terms of how much gold costs. Now, if we look at this chart to see what the stock market has done in terms of dollars since 2011, that is an accurate assessment. That was a good time to buy stocks. If we look at this chart, which is a chart of how gold has done in terms of dollars since 2011, that's accurate. That was a good time to sell gold. And so all we're doing here is just smushing those two things together and looking at stocks divided by gold, really. So when we reach the bottom of this trend line, that's a good time. That's when it's saying, hey, relative to real money, stocks are pretty cheap right now, according to their long-term growth trends. Now, obviously, back in 1980, there was an extreme, right? We went way below that trend line, and so that would have been a fantastic time. Anytime it's below this red line, that's really when you want to start going all in and buying stocks. That's when they're very cheap. Similarly, if we look at 2000, that was a time in which it would have been a very, very poor idea to buy stocks, right? That was signaling that stocks were extremely expensive compared to gold. That's when you want to start selling your stocks, and just loading up on gold, because that's really just a huge bubble indicator there, how expensive stocks were outside of the trend line compared to gold. Now, how do we apply this to today? Because, this goes through March, so it's probably looking a little bit more expensive today. That chart is probably a little bit higher as of today, because for the month of March, gold has basically moved sideways, hasn't done much for the month of March. And then stocks, since the month of March, since the beginning, have done pretty well. Now, it would be pretty upsetting if you approach this and said, as soon as it hits, the red line, on the top or the red line on the bottom, immediately then I'm just going to sell all of my stocks and go all in on gold, or vice versa. If it hits the bottom trend line, sell all of my gold, go all in on stocks. It'd be pretty frustrating to then see one of these bubble dynamics or extreme dips or sell-offs take place. It would be very frustrating to miss out on selling stocks at much higher prices relative to gold, or buying gold at much lower prices, much cheaper prices relative to asset prices. And so a more consistent approach that allows you to just slowly take advantage of this over time is simply rebalancing. So hypothetically, let's say you've got a quarter of your wealth in gold and a quarter of your wealth in stocks. Well, you're watching this take place, and let's say over the course of 3 months, stocks become more expensive relative to gold. What is that going to do to your overall portfolio allocation? It's going to take you from 25% stocks to maybe 30% stocks and only 20% gold, right? Because your gold might be doing nothing, but your stocks might be going up. And so relative to each other there, compared to your overall portfolio, that's going to change your percentages. And so all you have to do then is rebalance. Sell some of those stocks and use the proceeds to buy some more gold. Get yourself back to that 25% in each, assuming that that's in the hypothetical situation that is your allocation you're trying to hold. And that means over time you're going to be selling stocks and buying gold when stocks are expensive compared to gold. And then the opposite is true as well. If stocks crash compared to gold, let's say gold enters another bubble like we saw in 2011, that's going to give you an opportunity where your your gold portfolio allocation, the amount that you have in gold, is going to be a lot more than 25%. Let's say it goes up to 30 or 35%. That gives you an opportunity to sell some of that gold and buy assets that are on sale relative to gold. So even something as simple as quarterly rebalancing allows you to take advantage of trends like this and use real money to price the value of assets and take advantage of buying assets when they're on sale, storing up on real money when it's on sale, and then selling those assets when they become overvalued. It eliminates timing from the market completely. You don't have to be worrying, hey, are we about to have another crash? Are rates about to tighten? You don't have to worry about all these external factors. You're simply saying, hey, I'm keeping this core allocation, and every 3 months or so, I'm going to go in. I'm going to slice down the places that are that have grown too much relative to the other parts of my portfolio. And when you look at that strategy specifically, comparing gold to the stock market, it's a winning strategy. If you're not yet invested in gold and you're looking at this and thinking, hey, now is a great time to start building my position, there's 2 ways I like to buy gold. Number 1, I like using OneGold. Fantastic user interface, very cheap. You get allocated and segregated storage if you want to store it, especially if you want to store it in a private vault out of the country. And they make it really easy to do like auto investing, where you can invest as little as $5 a day to take advantage of the volatility. Use my link in the description below if you want to get a free $5 sign-up bonus. And second, if you have your money in a retirement account that you would like to use to invest in gold, I like to use iTrustCapital. Again, highly focused on security and technology to make it very easy for you to use. And use my link in the description below if you want to get your first month free. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.